There are many reasons why the relative strength index quickly becomes so popular with traders. Once understood and correctly applied, the RSI has the ability to indicate whether prices are trending when a market is overbought or oversold, and the optimal price to enter or exit a trade. That's why in today's video we will discuss the most important 10 trading rules and strategies you need to know about relative strength index. First, use RSI overbought oversold levels only in the combinations with the supply and resistance levels. And reading of the RSIs above 70 or below 30 isn't necessary and an invitation to enter a trade. In some instances, an asset may remain overbought or oversold for an extended period of time. If the price trend remains strong before acting overbought and oversold readings, examine price actions and make sure you identified all major support and resistance points in your chart and take signals from these key areas. Also, RSI by all short signals should always be evaluated within the context of the current trend in order to minimize risk. For example, if the price is forming a strong uptrend, you should ignore oversold readings and opposites the current trend. Always remember that RSI overbought and oversold area as solitary signals is not entirely reliable and requires complementary tools to strengthen and the signal. Second, use the RSI 50 levels to determine the dominant trend. The RSI displays the momentum of the price as value either above or below 50. When the RSI is above 50 lines, the price has upwards momentum, and when the RSI is below the 50 lines, the price has downwards momentum. When the RSI is crossing the center line, the momentum is switching from one direction to the other. And as in previous examples, always consider price actions when talking a trade. Here we have a trend line breakout with these candlesticks crossing above the resistance line. The downward was too strong to be reversed so easily, so I would not trust the resistance breakout. RSI confirmed that the resistance breakout was valid because it had moved up from the oversold area to 50 levels area and then broke above the 50 levels. This is how the RSI values can help you to confirm your trade setups. Third, add a moving average to the RSI to pinpoint entries exit. RSI can be used to provide entry signals during the trend, and to get the signals a moving average is applied to it. Once you add moving average on the indicators, you can take cross signals but not blindly. Again, consider a market context, add the major levels on your chart and take the signals in the directions of the main trend. A crossover between RSI and the moving average is a good signal when markets are trending. When price is in a range, this approach will lead to a lot of the false signals. From my experience, longer term moving average added on RSI will work better than short term moving average and will produce fewer false signals. So instead of adding a 10 moving average on the RSI, for example, I advise you to apply 50 moving average or a 100 moving average and start from here. You can then decrease the length of the moving average after you backtesting the signals. Fourth, use RSI regard divergence to find reversal points. RSI regular divergence can be either bullish or bearish. A bullish divergence occurs in a downtrend when the price actions prints over lows that are not confirmed by RSI. That indicates a weakness in the downtrends as selling is less urgent or buyer are emerging. When the RSI fails to confirm the lower lows on the price actions, it makes higher lows. A bearish divergence occurs in the uptrend when the price actions makes high highs that are not confirmed by RSI indicator. This indicates weakness in the uptrend as buying in events indeed and selling or profits taken is increasing. As with the positive divergence, the RSI falls. As is a positive divergence, the RSI fails to confirm the higher heights and the price actions by making lower heights. RSI regular divergence can be used as the reversal signs to pinpoint the end of the price swings and is more efficiently used in conjunctions with other trading techniques such as trend lines, breakouts, support and resistance breakouts, and candlesticks patterns. Fifth, the use RSI hidden divergence to identify high probability pullbacks. A hidden divergence on the RSI occurs when the trend holds up despite the momentum doing against it, offering continuation signals. Hidden divergence can help you identify pullbacks that have the high probability of working out. In an uptrend, there is a hidden divergence when the market is making the higher lows, but the RSI indicator is making the lower lows. And in the downtrend, there is the hidden divergence when a market is making a lower high, but the RSI indicator is making the higher highs. Remember that hidden bullish RSI divergence only happens in the uptrend and the trend should continue to the upside, whereas only hidden bearish RSI divergence only happened in the downtrend and the trend should continue to the downside. Common mistakes that many traders makes while trading is the minute they notice the divergence they take the trade accordingly in order to identify the pullback efficiency. Hidden divergence on the RSI is the more powerful when used in conjunctions with trend lines breakouts, support or resistance breakouts, and candlesticks patterns, as in the case of the regular divergence. 6. Combines RSI with the leading indicator or better results in order to achieve a proper balance in your trading. You can mix the lagging signals coming from the RSI with the leading indicator. The reality is that RSI is a lagging indicator which follows price momentum and doesn't have reliable, predictable qualities. Leading indicators, on the other hand, are able to indicate when major moves in the markets would occur. The most efficient trading tools you could use to combinations with the RSI are pivot points and Fibonacci retracement. For example, plotting pivot points will allow you to know in advance several key levels for the next days, and if the price reaches the main pivot point, for example, they will be reaching a rejection or the breakout. A high probability signal would be hidden divergence on the RSI occurring to the central pivot points for the day, or a regular divergence occurring in the R2 levels, or you can use the Fibonacci retracement levels with the RSI. You can enter after the RSI hidden divergence in the uptrend when the price rejects an important FIB levels, or you could combine and oversold RSI with the 50% FIB levels, for example. The key is to find the confluence between leading and the lagging tools. 7th, use RSI trend lines to find optimal entry points on overbought methods of the RSI is the use of trend line directly on the oscillator itself in much the same way that they are used to the price chart. By connecting to using swing lows on the RSI is the uptrend or low trend swing highs in a downtrend, you can find trading opportunities because RSI means the surge in the closing price. When RSI changes directions and entries breaks above or below the trend line. A significant move in the price can result in strongly advise you to use RSI trend line on the higher time frames. The rules of this approach are straightforward. You only need to connect the most recent RSI peaks or values with the trend line and to search for the breakout of the trend line, which will warn you that the market has lost its steam and prevailing trend has lost its momentum. Also, don't use a RSI trend line as the reversal signals. Here's the combination mistakes. Many traders, when they spot a strong uptrend and identify a trend line breakout of the RSI, they go short. This could work, but a safer entry would be to concentrate on breakouts in the directions of the main trend. In this case, focus on breakouts to the upside on the RSI. 8. Use RSI to combinations with the candlesticks patterns. For example, you can see the bearish engulfment candles combined with the bearish RSI divergence at the double top. So as price is testing the double top, the RSI indicator is showing a clear bearish divergence. We see a strong reversal signals with the price printing bearish engulfing candles. This tells us that there has been a shift in supply and demand at the levels. The presence of the bearish engulfing candles at the double top with bearish RSI divergence is a strong set to criteria for placing a short trade. In this other example, you can see that the bearish pin bar is another double top with overbought RSI. So with the price testing the resistance levels and with the RSI is overbought territory, this means that the price was vulnerable to the reversal. The formations of the bearish pin bar would then confirm the trade and offer to entry point. Pin bars similar to the engulfing candles represents a strong shift in the underlying supply and demand balance. When you combine RSI reading regardless with candlesticks patterns for the trade entries, you obtained more powerful signals. 9. Use RSI on the multiple time frames for the better price analysis. On the effective RSI trading strategy involves a multiple time frames approach. The underlying idea is to go with the large theme on the higher time frames and then drill down to the lower time frames in order to gain better timing and to increase your risk-reward ratio. A simple way to exclude an RSI multiple time frames analysis is to use it with the same settings on the two different time frames. You can then catch the momentum when both the higher time frames indicator and the lower time frames indicators come from oversold or overbought and are moving in the same directions. 10. Adjust the look back period to make the RSI more or less variable. You must always tweak your RSI settings depending on your favorite time frames or trading styles. A shorter RSI period below 10 will be very valuable and will generate a lot of the signals, but will have lower levels reliability. Longer RSI period above 20 smooths out the plotted line and will generate fewer and potentially more accurate signals. RSI is considered overbought when above 70 and or sold when below 30. The traditional levels can also be adjusted to better fit the market you're trading. Rising overbought to 80 or lower oversold to 20 can help you to reduce the number of the signals. The truth is that there is no right or best period, and being considered is more important than the exact number itself. The selections of the walk back periods should be based on your data time, horizontal trading styles, and the way you use every site in general. If you got any value from this and learned something new, leave us a like, show your support, subscribe to our channel, and click the bell icon to stay in touch when we upload new video. Until next time.